Long before charts became crowded with oscillators, Fibonacci tools, and glowing signals that promise certainty, one man predicted market reversals using nothing more than price, logic, and human behavior. If I pause the noise around modern trading long enough, I can still hear the echo of what Charles Dow tried to warn every generation of traders about. Price doesn't whisper, it announces. But it only announces to those who have the discipline to listen. Before indicators existed, before software existed, before even standardized charts were common, Dow predicted market reversals by identifying a simple truth. Markets change direction when human behavior changes, not when an indicator flashes. If you had to trade with 0 indicators, what would you rely on? Comment your answer below. And this is where our journey begins, with a man who looked at the markets the way a seasoned sailor reads waves. Dow didn't check tools, he read behavior. And he realized that every reversal, big or small, left behind a set of footprints that emotional traders couldn't hide. Most traders today think reversals come from RSI, overbought or oversold, MACD crossovers, divergences, volume spikes, moving average flips. But Dow watched the markets before these even existed, and his insights still outperform most modern tools. Why? Because while indicators evolve, human nature does not. Dow's method was terrifyingly simple. Spot the moment when the market breaks its character. That break, that subtle shift in behavior, was more powerful than any indicator ever created. His philosophy aligns perfectly with Jesse Livermore's. The market is never wrong, opinions often are. Dow and Livermore were separated by time, but connected by mindset. Both men believed you don't predict the market, you observe its change. And every reversal began with a change. This isn't a technical lecture. It's a documentary about how one man understood human nature so deeply that he could read reversals the way a doctor reads a heartbeat. The market doesn't reverse when traders think it will. It reverses when traders refuse to believe it can. There's a strange conflict inside every trader, the same conflict Dow saw over a century ago. It's the tension between what the market shows and what the trader wants. This internal tug-of-war is the root of almost every blown account, every early exit, every late entry, and every missed reversal. Dow's greatest insight wasn't technical, it was psychological. He realized that a market reversal begins long before price turns around. It begins inside the trader's mind. Dow noticed that traders only believe a reversal after it has already happened. They want confirmation. They want comfort. They want the market to tell them, hey, it's safe now. But by the time the market gives comfort, the move is already gone. Dow wrote, "The trend persists until a definite signal of reversal appears. Not emotional relief. Not news. A definite signal, a structural shift. Traders today? They wait for indicators to confirm what the price already revealed." Dow didn't need confirmation. He trusted behavior before indicators. Dow observed this repeatedly. When a reversal begins, you can feel the hesitation. You can feel the imbalance. You can feel the rhythm change. But traders suppress the feeling because their ego is louder. Jesse Livermore warned the same thing. Men who can be right and sit tight are uncommon. Dow and Livermore understood. The hardest moment to accept market truth is the moment your bias is most emotional. This is the part modern traders don't believe. Reversals aren't sudden. They develop, like a storm gathering strength. Volume changes character. Rallies become weaker. Sell-offs start losing aggression. Support begins to take deeper hits. Highs stop extending. Lows stop breaking with force. None of this requires an indicator. Just observation. Just discipline. Dow saw these shifts as behavioral warnings, subtle cracks in the trend that the average trader would ignore because they were emotionally married to their bias. Dow predicted reversals not because he was gifted, but because he was brutally honest with the one thing that deceives all traders: themselves. This inner conflict between what the market shows and what the trader believes is the battlefield Dow walked into every day. And it's the same battlefield you face every time you open a chart. This is where Dow's genius becomes undeniable. The market rarely surprises you, your own mind does. If you've ever stared at a chart and thought, "I knew it was reversing, why didn't I act?" then you've already stepped into the psychological trap Charles Dow understood better than anyone. This trap is invisible, silent, and incredibly powerful. It convinces traders to ignore the very signals they claim to be searching for. Dow realized something that modern traders still ignore. Reversals don't hide from traders, traders hide from reversals. And they do it unconsciously. Let's break down this trap in its true form. The hope reflex. Dow observed this among early tape readers. When traders are in a losing position, they don't look for truth. They look for hope. A small bullish candle? It's reversing back up. A bounce on minor support? See, the trend is still intact. A news headline? This will help my position. Instead of seeing weakness building, they see hope. Instead of accepting the trend break, they cling to the old trend. Dow wrote indirectly about this through his observations of trend behavior. A trend is considered intact until clear evidence proves otherwise. But emotional traders flip the logic. They consider the trend intact even after evidence proves otherwise. Hope destroys clarity. Hope blinds reality. Hope delays action until the reversal is undeniable, and losses are unavoidable. The familiarity bias. Dow recognized something modern psychology later proved. Humans trust what feels familiar. If a trend has been bullish for weeks, the mind becomes conditioned. We are going up. We should continue going up. So when weakness appears, lower highs, shallow pullbacks, fluid breakdowns, distribution volume, the brain rejects the unfamiliar pattern. Dow didn't trust the familiar. He trusted the change in character, the break of rhythm. Livermore echoed the same idea. The market does not beat them, they beat themselves. Both men understood. When behavior changes, direction changes. Ignoring it is suicide. The confirmation addiction. This is the trap every indicator trader falls into. Dow didn't believe in indicators because he understood a deeper truth. Every trader is addicted to reassurance. People want the MACD cross. They want the RSI divergence. They want the EMA flip. They want volume confirmation. But reversals don't give confirmation. Reversals require recognition. Dow trained his mind to see the earliest signs. A rally that fails to break the previous high. A sell-off that stops creating lower lows. A breakout that loses momentum. Volume spikes that go unnoticed by the crowd. These are the early warning signs of behavior, not indicators. By the time confirmation comes, the smart money has already entered. And the crowd is once again late. The ego shield. Dow understood something brutal. The ego hates being wrong. And reversals force you to accept you were wrong about the trend's continuation. Most traders don't lose money because of analysis. They lose money because their ego refuses to adjust. Modern traders say, "I'll wait for proof. I know the trend is still up. It's just a pullback." Dow had only one question. Has the character of the market changed? If yes, the ego must step aside. If no, maintain the trend bias. That was his entire framework. All these traps: hope, familiarity, confirmation, addiction, ego, create a psychological blindfold. And that blindfold is the reason traders miss reversals every day. Dow never looked for tops, he looked for changes, and that's why he saw reversals before everyone else. Before indicators, before chart patterns had names, before technical analysis even existed as a field, Charles Dow developed a method so clean, so logical, and so rooted in human behavior that modern traders still can't surpass it. Now let's enter the mind of Charles Dow, not through myths, not through internet opinions, but through his actual writings in the Wall Street Journal. Dow believed the market spoke through movement, not indicators, not predictions, not emotions. Movement. And every reversal left 3 fingerprints. Let's break them down exactly as Dow taught them. Fingerprint #, the market makes a lower high or higher low first. This is Dow's most misunderstood but his most powerful insight. Dow said a trend stays intact until a definite sign of reversal appears. And what is the first definite sign? Not a trendline break, not a moving average flip. It's the failure of the market to continue making progress. In an uptrend, highs must continue rising. Lows must continue elevating. When the market makes the first lower high, Dow called it the market showing hesitation. It's the earliest sign of distribution. In a downtrend, lows must keep falling. Highs must keep declining. When the market prints the first higher low, that is accumulation beginning quietly. Dow wasn't predicting. He was observing deterioration. This insight was revolutionary because Dow realized the first sign of reversal is not the turn, it's the failure to keep moving forward. That single idea created modern trend theory. Fingerprint #2 secondary movement violates the primary trend. Dow divided movement into 3 levels. Primary trend, the big tide. Secondary reaction, the waves. Minor swings, the ripples. The reversal arrived when the secondary movement became so strong, it violated the structure of the primary trend. Example: if an uptrend pulls back deeper than previous pullbacks, Dow said this was structural weakness. Not noise. Not randomness. Dow didn't guess the reversal. He waited for the structure to betray the trend. Livermore had the same philosophy. The big money is in the big swing. Dow identified when that swing was ending. Fingerprint #3, volume, confirms the change in character. Dow never used volume as a signal. He used it as a lie detector. He observed, rising volume on a down move during an uptrend is distribution. Rising volume on an up move during a downtrend is accumulation. He didn't need an indicator. Tape action told him everything. When price weakens and volume strengthens against the trend, Dow saw this as smart money preparing for reversal. Dow believed the public moves late, professionals move early, and volume reveals them. This was not theory. This was what he witnessed daily. Dow's core philosophy summarized. Everything Dow believed about reversals came down to 3 questions. Has the trend failed to make further progress? Has the secondary movement broken structure? Is volume shifting against the trend direction? If the answer to all 3 was yes, the primary trend was ending. No guessing. No predicting. No emotional bias. This is how Dow predicted reversals without indicators, using logic and behavior. Dow never predicted reversals. He forced the market to prove one had begun. Every trader, including you and me, faces the same internal enemy: the urge to anticipate, to get in early, to be the first one right, to catch the top or bottom. But Charles Dow had zero interest in being early. He had zero desire to guess the turning point. His goal was simple: don't predict, don't hope, don't guess. Just let the market prove itself. Dow's breakthrough rule, the heart of Dow theory. Dow wrote, a trend remains in force until a clear reversal is proven. Not suspected. Not felt. Not predicted. Proven. This single rule separated him from every emotional trader, both then and now. Let's break down what Dow meant by proven, because this is where the power lies. Proof has shown a failure of progress. Dow required the trend to fail before he even considered a reversal. For an uptrend, that meant a rally that fails to make a higher high, a push that lacks strength, a visible loss of demand. For a downtrend, a sell-off that fails to make a lower low, a sudden weakness in momentum, a decrease in supply pressure. Dow didn't call reversals based on candles. He called them based on the logic of trend behavior. If the trend couldn't keep doing what trends do, Dow considered it the first crack. Proof #2, a break of structure. Dow's next requirement was structural, and this is the part modern traders ignore. For an uptrend, a reversal begins when price breaks beneath a previous major low. For a downtrend, a reversal begins when price breaks above a previous major high. Dow didn't need Fibonacci, or RSI, or MACD, or divergences. Structure was enough, because structure reflects behavior, not noise. Livermore echoed the same idea decades later. The chart is nothing but a picture of human nature. Humans change behavior before they change direction. Proof #3 volume must agree. Dow didn't trust price unless volume confirmed the shift. He wrote, "Volume is the force behind movement." So when down moves gained volume in an uptrend, up moves gained volume in a downtrend. He saw that as professional activity, the kind that precedes reversals. Volume wasn't a signal. It was a truth detector. If price action looked like a reversal but volume disagreed, Dow waited. He didn't let emotions trick him. This patience is what made his insights legendary. The power of this rule. By forcing the market to prove itself, Dow eliminated emotional bias, premature entries, risky predictions, ego-driven trades, impulsive reactions, and replaced them with clarity, objectivity, consistency, trend alignment, logical decisions. Dow understood something simple but life-changing. If you require proof, you'll never be fooled by a fake reversal. Most traders lose because they see danger too late. Dow saw it early because he wasn't looking for danger, he was looking for evidence. Let's see how his rules apply directly to you today. Every trader wants to catch a reversal before it happens. They want to see the top forming while everyone else is still euphoric, or the bottom forming while everyone else is still terrified. But Charles Dow warned something powerful, something traders still ignore 120 years later. Markets rarely reverse without first revealing a loss of momentum. He wasn't talking about MACD crossovers, divergences, RSI, or oscillators. None of these existed. Dow was talking about a behavioral slowdown, a shift in the rhythm of price itself. And that slowdown shows up in only two places: the behavior of secondary reactions, the failure of price to reach previous zones of strength. This was Dow's quiet way of saying, trends die slowly, then all at once. 1. The slow death of a trend, Dow's natural warning. Dow wrote that every major trend has a life cycle: birth, expansion, speculative exaggeration, exhaustion, reversal. What modern traders miss is that Dow believed exhaustion isn't a candle pattern, it's a change in the quality of movement. In bullish trends, rallies become shorter, pullbacks become deeper, recoveries become hesitant, new highs become weaker and slower to form. Sound familiar? It's the same behavior seen before every major top in history, from the early 1900s railroad peaks to modern tech booms, and none of it requires an indicator. Dow was clear. When a market fails to respond to favorable news, the upward trend is near its end. That one sentence alone predicted dozens of major tops. Because bullish markets normally overreact to good news, not ignore it. 2. The secondary reaction that changes everything. Secondary reactions were Dow's masterpiece, his single most misunderstood but accurate tool. They are not pullbacks. They are structural countermovements that test the strength of a trend. Dow said you must watch how price recovers after a secondary reaction, because that recovery reveals whether the trend still has breath, or whether it's about to collapse. Here is the exact sequence Dow would look for before a reversal. Step 1. A secondary reaction forms. A deep, meaningful move against the dominant trend. Not a tiny dip, something significant. Step 2. A rally follows but without power. This is the critical part. The rally should push back strongly if the primary trend is healthy. If the rally is sluggish, narrow, short-lived, fails to exceed the previous high, then Dow considered it a warning rally. Step 3. The secondary low gets taken out. Once price breaks the low of the secondary reaction, the trend is officially reversed. No guesswork, no indicators, no candle patterns, just pure structure. This is exactly how Dow predicted reversals decades before technical analysis even existed. 3. The silent failure, Dow's most powerful reversal signal. There is one signal Dow respected above all: failing to reach the previous high in an uptrend, failing to reach the previous low in a downtrend. He believed this was the earliest, cleanest sign that momentum has left the building. To Dow, a trend that can't push farther has already begun dying. A trend that hesitates at old levels has exhausted its dominant force. A trend that reacts poorly to news has psychologically shifted. In other words, price itself announces the reversal long before traders notice. 4. Why traders ignore this simple truth. Modern traders want speed, signals, alerts. They want the perfect top and perfect bottom. But Dow didn't believe in perfection. He believed in behavior, because behavior never lies. A trend reveals its weakness the same way a person reveals fatigue. Steps become heavier, pace becomes slower, energy becomes inconsistent. Dow simply watched the tiredness of a market. And that is how he predicted reversals without indicators, using nothing more than structure, momentum behavior, secondary reactions, failure to surpass previous levels. Nothing else. Charles Dow believed that markets do not reverse suddenly or randomly. They reverse through a two-stage psychological shift, predictable, measurable, and visible long before the actual trend breaks. Dow didn't use indicators, because the market itself was the indicator. And he taught that every major reversal contains two undeniable stages. Stage 1, the market stops advancing, but traders don't notice. This is the quiet phase, the invisible phase, the phase where an uptrend is still technically intact, but its character has already changed. Dow wrote that the market gives early warnings through behavior, not patterns. Here's how he described it. 1. The market rises on shrinking volume. Dow believed that healthy trends are fueled by broad participation. When fewer participants support the move, the foundation weakens. This didn't require volume indicators. Volume was printed daily in newspapers. Dow simply observed the flow. 2. The market stops responding to good news. This is one of Dow's most powerful observations. A bullish market overreacts to good news, shrugs off bad news. But just before a reversal, this flips. Good news fails to push price higher. Bad news suddenly has more impact. This is psychological exhaustion. Dow called it the loss of the primary force. 3. Rallies become weak and fast selling. In a real trend, rallies climb like a staircase. Steady, confident, predictable. But before reversal, they rise like a tired breath. Short, weak, easily knocked down. 4. Price returns to previous lows too quickly. Strength disappears. Momentum evaporates. Support becomes fragile. Everything looks almost normal. But something is clearly off. This is stage 1. Traders think the trend is fine. Dow would already be preparing for reversal. Stage 2. The market breaks the critical level. The moment Dow considered the trend officially dead. Dow's great contribution to trading was clarity. He did not guess, predict, or gamble. He waited for confirmation. Real, structural confirmation. Stage 2 happens the moment price breaks. The previous secondary low in an uptrend. The previous secondary high in a downtrend. This was Dow's line in the sand. Not before. Not after. Not maybe. Only this break mattered. This is the moment the trend officially reverses. And this is why Dow never needed indicators, because he trusted price structure, not prediction. The genius behind the two-stage reversal. What makes Dow's method legendary is that it captures both. Psychology, stage 1, loss of momentum. Confirmation, stage 2, break of secondary level. Most traders pick one. They act too early, emotionally. Or too late, technically. Dow created the bridge between these two extremes. Stage 1 reveals the truth early. You see the internal weakness before the chart breaks. Stage 2 confirms the reversal with evidence. No wishful thinking, no guessing, just structure. This is pure Dow. Uncomplicated, elegant, Timeless. Why most traders fail to see the two stages? Because stage 1 looks subtle. Too subtle for emotional traders. They want fast signals, flashy indicators, dramatic patterns. They want something to tell them. But Dow believed the market already tells you. If you're paying attention, traders ignore stage 1 because it doesn't break any rule. It doesn't invalidate the trend. It doesn't look dramatic. It doesn't feel urgent. Yet, stage 1 is the most important because it shows the psychological shift inside the trend long before the obvious reversal. Stage 2 is simply the execution point. The Dow mindset: reversals are not events, they are processes. This is the key. A reversal isn't a candle. It isn't a pattern. It isn't a level. A reversal is a process of strength leaving the market, step by step, behavior by behavior. Dow never tried to predict reversal. He simply followed the evidence. And that is why he never needed indicators.